Okay, so today we are breaking down one of the boldest, most aggressive calls you'll find on Wall Street right now. It's a massive new target for the stock market that has absolutely everyone talking. And you'll see in a minute, it's coming from a very, very unexpected source.
And there it is, 7,800. That is Morgan Stanley's new price target for the S&P 500. Now, to be clear, that's not for next month, it's for the end of 2026. But still, it's a number that implies a massive, massive rally from where we are today. If it happens, it would lock in the fourth straight year of double-digit gains for the market.
But you know, the real story here isn't just the number itself. It's the person behind it. Until just recently, Morgan Stanley's chief strategist, Michael Wilson, was famous for being one of Wall Street's biggest, most stubborn bears. So the real question we have to unpack is, what on earth just changed? To really get why this 7,800 target is such a big deal, you first have to understand the absolutely dramatic pivot that made it happen. I mean, the whiplash here is just incredible. All through 2023, Wilson was digging his heels in, calling for a market crash while the S&P 500 just kept climbing, finishing up 24%. He missed the whole thing. And now, he's completely flipped the script, putting out one of the most aggressive, most bullish targets on the entire street. It is a monumental shift. And listen to how he's talking about it now. He's saying we're in a new bull market that's so powerful and moving so fast that if you wait for a pullback, you might miss it entirely. So in his mind, this isn't just some temporary rally. No, this is a fundamental regime change for the whole market.
Okay, so having conviction is one thing, but how do you actually land on a number as specific as 7,800? Well, it all comes down to the math.
At its core, the formula is actually pretty simple. First, you have to guess how much profit all the S&P 500 companies are going to make in the future. Second, you estimate what price tag, or multiple, investors will be willing to pay for those profits. You multiply the two together, and bang, you've got your price target. But of course, the devil is always in the details. Now this right here, this is the real engine of the whole thesis. Look at that huge jump in 2026, a massive 17% acceleration in earnings growth. And here's the kicker. Their 7,800 target for the end of 2026 is based on the earnings they expect in 2027. They're betting the market is going to start pricing the future in much, much faster than it normally does. Then there's the other half of the equation, the valuation. They're projecting the market will trade at a 22 times price to earnings multiple. To put that in perspective, that's nearly 20% higher than the average over the last 10 years. So they're not just saying things are good, they're explicitly arguing that the market has fundamentally changed and now deserves to be permanently more expensive.
So you've got these supercharged earnings and this premium valuation. What on earth gives them the confidence to make such a bold call? Well, their entire case is built on three foundational pillars.
And those three pillars are, first, a broad-based explosion in corporate earnings. Second, a massive productivity boom that's being driven by artificial intelligence. And third, something they call a policy trifecta, basically perfect conditions from the government and the Fed. Let's just quickly unpack each one.
The whole earnings explosion idea is all about this one key concept, positive operating leverage. It sounds fancy, but it's simple. Companies got really lean and efficient during all the recent uncertainty. Now, as the revenues start to grow again, that extra cash drops straight to the bottom line because their costs are already fixed. It's like a turbocharger for profits.
And here's what's really important. This isn't just another story about big tech. The whole thesis is that we're finally shifting away from a market that's been carried by just a handful of giant stocks. Instead, we're entering a rolling recovery, where that strength starts to broaden out to the entire market, and that makes for a much healthier and way more sustainable bull run. So on top of that broadening growth, the second pillar is that massive AI-driven productivity boom, which they think is just going to pour fuel on the fire of efficiency and profits. And then the third pillar, the one that supercharges everything, is what they call the policy trifecta. This is the dream scenario. You've got supportive tax policies, you have expected rate cuts from the Fed, and you have a friendly regulatory environment. It's basically the perfect storm of tailwinds for the stock market. So the bull case is definitely compelling. But, and there's always a but, for this forecast to actually come true, the economy has to walk a very, very fine line. And this brings us to the central risk, the Goldilocks dilemma.
You can see the tightrope the economy has to walk right here. If things run too hot, you risk inflation roaring back to life, and that forces the Fed to keep rates high. That would kill the bull case.
But if things run too cold, we could slip into a recession, and companies would obviously miss those super aggressive earnings targets. For 7,800 to happen, everything has to be just right.
So the crucial point here is this: if conditions aren't perfect, that premium 22 times valuation is the first thing that's going to collapse. In Morgan Stanley's own bear case scenario, just one stumble by the economy could send the market plunging all the way back down to 4,900. The stakes are incredibly high.
Okay, so how does all this translate into an actual investment strategy? If you hear this forecast and you believe it, what are you supposed to do? Well, because the whole idea is that the recovery is going to broaden out, the playbook starts to shift. Morgan Stanley is recommending investors overweight the sectors that benefit most when the economy is really humming. So we're talking about areas like financials, industrials, consumer discretionary, and healthcare. It's a classic rotation out of that really crowded mega-cap tech trade. And maybe their number one piece of advice for investors is this: don't wait. Don't try to get cute and time the market. They believe this bull market is going to be so powerful and move so fast that any market dips, any little pullbacks should just be treated as highly attractive entry points to get on board. Which, of course, leaves us with the final, multi-trillion-dollar question. Has Wall Street's former biggest bear correctly called the beginning of a truly historic, accelerating run for stocks? Or is this 7,800 target just a bull trap? One that's built on a perfect, just right scenario and a pile of risky assumptions that just can't withstand the first real shock? The answer to that is going to define this market for years to come.